let's use here for 2018. So we are taking the figures that will be going to P&L and other comprehensive income. They didn't even ask us to take what to go to the SOFP, but we all know that this is the SOFP figures. So when you combine, I think it's 35,000. So those ones will go to SOFP. Now they want the one that will go to P&L. In 2017, P&L. So in 2017, we have P&L of 500 depreciation. Then we also have some revaluation surpluses in 2017, which that one will be OCI. So revaluation surplus will be 4,000. Depreciation before and depreciation after revaluation is what will be affecting 2018. So 2018 P&L, yes, we all know that there is depreciation of how much? 550, which is going to P&L 550. Then there is a revaluation loss over here in 2018. When there is a revaluation loss, what is the treatment? Yes, who can tell us? What is the treatment when there is a revaluation loss?
Hello, sir.
Yes, please.
It will go to P&L.
You credit P&L and debit revaluation.
I don't understand. Credit P&L and debit revaluation.
Sorry.
Somebody said revaluation loss will go to P&L.
P&L, yes.
It is true, but it's not true.
Hey. Hello, sir.
Yes, please.
We will have to list it from the previous balance gain.
All right.
On the OCI.
Okay. So the same, if you check land, there was a previous gain of 1,006. So we have to match. So what we will do is that the P&L revaluation loss in the P&L will be the remaining 1,000. Then the 1,006, which is with the gain that was there before, we have to go and match it off. So revaluation loss will be 1,006 to go and match it off the previous gain. All right. So thank you very much. The same thing for this one. The same thing for this one. You have to go and match the previous gain of the revaluation before any surplus will go to the P&L. So how much is that? So if we had done the total, this one would have been how much? So that we treat it once instead of treating it one by one. So let's bulk the totals because it is 1 year item. So please, what is the total for this side?
$7,450.
7,450.
Yes, sir.
And before there was 400 there. So revaluation loss, 4,000 there. Revaluation loss will first pass here, 4,000. To cancel the one that is here. Then the difference is what? 3,450, which will go to the P&L. Revaluation loss. All right. Is that all?
Yeah, the transfer.
The transfer. Okay. So how do we handle the transfer? Depreciation before transfer was 500. Depreciation after transfer is what? 550. There is a difference of 50.
Yeah.
So that 50, what did we say you do? That 50 will also go to the revaluation. You take it from revaluation So excess, this is the reason why we are doing the transfer from surplus. So excess depreciation. You are taking it out, so 50. Then to retain earnings, you will just draft something and say retain earnings. Excess depreciation. That one will be here. So you won't put it in bracket. Yes, any question? We are done. I'm just going to go on to do the two standards.
Hello, sir.
Yes, please.
Sir, please, why did you bring the 500 to 2017? The building.
Which 500? This one?
Yeah, the building.
The building. You said, why did I bring 500 here?
Yeah, that one.
It's the depreciation for the year.
Is it the same? Is it the one up there after the cost that you brought down?
No, it's the depreciation for every year. The useful life is 50. So you find depreciation for every year.
That means every year you bring the 500.
So long as they've not revalued it. You have to find depreciation for every year.
Okay. So because 2018 is revalued, that's why you didn't bring it and you brought the revalued figure.
The new figure as at at the end of 2017 was this one. It was no more this 25. This is the new figure. So that is what we continue the revaluation with the remaining useful life of 48. And that is where we had the 550. This 550.
So yes, I understand. I was asking why the 500, but now I understand that you revalue it every year.
Yeah. So they revalued it. So please, this thing is coming from what we did last week, PPE. I mean, so in a PPE, all you need is how to find the cost, which sometimes they can trick you, give you some information for you to combine to get the cost. After that, the next thing you need to learn how to do is to do how revaluation is treated, revaluation loss, revaluation gain, and depreciation. Because after your initial measurement, the next thing is your subsequent measurement. The subsequent measurement is the cost model or the revaluation model. And if the revaluation model is applied, you need to know where revaluation surpluses and revaluation losses, especially the revaluation loss. It is not straight P&L. I gave you a caveat on those things. So you have to be very, very careful how you go around it. All right. If you understand it like that, there's no question that you can't do. You can, there's no question you can. All right. So it's 6 o'clock now. I want to move straight to the two standards that I want to treat today. All right. So like I said, I'm doing 2 standards today, and I'll do 5 tomorrow. Okay. So let's go on.
Sir.
Yes, please.
I beg. Can you throw more light on the excess depreciation of 50? Taking from the 4,000 here.
Because I want to move forward, I would ask that you go back and watch last week's video. It will help you. Other than that, I won't be able to. I beg you, just go back and watch last week. You will have everything, don't worry.
Okay. So I get it. 550 minus 500.
Okay. I want to look at two standards in the next lab. So we want to look at government grants. And please, I'm starting a standard. This is the point where I need you to listen. And if you have to make notes, make notes. If you miss this part, that will be it. You'll be asking questions when we are solving the problem, which those questions would have been answered if you listen to this part very carefully. So please listen very carefully. Okay. So always we will do definition. We will do recognition. We will do measurement. All right, and the measurement, as you all know, maybe subsequent and initial, but over here, we don't really need that. The two definitions I'm going to give you, the two concepts over here will be the government. When we say government, we are talking about government as in the government of Ghana or government of a foreign land or any international bodies. So government means the government of Ghana, which includes the local government, then international bodies, which include something like IMF, USAID, and all those bodies, UNICEF and all those. The next thing you need to understand is what we call government grants, the grant itself. All right, the grant. What is a grant? Now watch this. This is the very important aspect you need to listen to. When we talk about the grant, we are talking about economic resource. All right, the key word is economic resource that you get from the government. And when I say government, these are what I'm talking about. All right, economic resource. Then the last aspect of it you have to take note is that usually after obeying certain conditions, or usually agreeing to obey certain conditions. Let me use that word like that. Okay, so you agree to obey certain conditions and they give you the grant. That is what. All right, we all know all these things. Government is going for those. We all know what these things mean. All right, then there is another definition that I'm going to talk about. Which is also very important. You call it government assistance. Government assistance. Now, there is a difference between the grant and the assistance. The grant is like economic benefit. So you see, this one is economic resource, meaning we are talking about money, cash. All right, cash. Okay, this one too is an economic benefit. All right, So the same thing. It's the same English. So, but let me say for honoring certain conditions. So you have to put the difference in the two. I'll give you some simple example to explain it. Number one is that if the government is giving you 10,000 Ghana cedis as a grant, then it means that that grant is monetary, and you will know that you can hold it in physical money. So that is what you have. But if the government says that go to free zone, you won't pay tax for the next 10 years, that one is an assistance. All right, it's an assistance. So if you fall under certain criteria, that is the one that we are talking about. Now, this one involves transfer of economic sources, economic resources. That's the key thing you need to know. Transfer of economic resources. This one is a benefit that you get. So if the government gives you something like a tax rebate for going to set up a business at some place, it's an economic benefit. It's not the resource. So I always tell students that understand the assistance to be a level playground. If you fulfill certain conditions, like for example, in Ghana, our tax law will say that if you are not located in the regional capital, so regional capital, let's say a manufacturing company located in the regional capital, those of you who have done taxes, it says you have to pay a tax of 25%. But if you are located, if you are in Accra Tema, it's 25%. In any other regional capital apart from Accra Tema, it's what, 18.75%. In any other place, it is 12.5%. So you see, if you now go to those places, you are paying a tax of 12.5%. You are having an economic benefit of the remaining 12.5% you did not pay, which somebody is in Accra Tema is paying. So it's a level playground. So if you can go there, you get it. One is the physical release of cash. The other is the benefit. All right, is the benefit. Sometimes the benefit can also be cash, but it will not be like the grant where you are handed the cash over. Because the truth is that the tax you are not paying is cash. But as at that particular moment in time, you cannot. So if the government gave you the level playground on, let's say, January 1, gave you an assistance of January 1, 2022. As at this particular January 2022, you've not even finished your financial statement to know that you are not going to pay the tax. So as at this time, you will not know. You can only get to the 31st December to know that, oh, I made profit and I'm supposed to pay 25%, but the government is telling me to pay 12.5%. Therefore, I will certainly have an amount of so and so, which I'm not paying as tax. So you see the two differences that I'm giving you. Please, is that okay? Is it okay?
Yes, sir.
All right. So please, that is it. The recognition criteria for a grant is two. We have two. Number one is that you will definitely receive the grant because recognition number one is that you fulfill the condition to the grant. All right. You fulfill condition to the grant. Most of you have done public sector, so these things. So the entity will fulfill the conditions to the grant. Because we said that the grant is given after you have agreed to obey. So if you don't obey, then you can't have the grant. So the entity will fulfill the conditions to the grant. Number two, there is reasonable certainty that the grants will be received. This is prudence concept. All right, so the grant will be received. If you know you will not receive, if you are not so certain that you will not receive the grant, then you cannot recognize the grant. All right, so these are the two major recognition criteria. All right, so please take note of this. Then we come to measurement. The measurement, we will have to distinguish between the grants. So we have to, number one, talk about revenue grants, or what we call grants related to income. Then we have grants related to assets. So it's either the grant is received, so this one we call it revenue grant. And this one, we call it what? Capital grant. If the grant that is given is to help you incur some expenses, then it is a revenue grant, all right? But if the grant given is to help you purchase some assets, then it is capital grants, all right? So those are the two things you need to understand. Now, under each of these types, we have two treatments, okay? Two treatments. So I'm going to discuss quickly the methodologies for dealing with the grants. So the two treatments are simple. Now, this one, we have direct offset. And we have, I want to call this one the deferred. Or, well, I'll explain it. You have to give it the proper name you want to give it, but okay, treating the grant as income. So the same two things here too. Direct and deferred. Now, let's take this example. So I said that this one is a grant that is related to expenditure. This one is a grant that is related to an asset. The only difference between these two is that, asset is depreciated, expenses are not depreciated. So that is the only difference that arises between the two. I'm going to open a fresh page to deal with this, and I will explain it in a simple term for you to get it. So first of all, let me just select here and call here revenue grant. Call here asset grant. And I said we have the direct, we have the deferred. Direct, deferred. Okay, so let's use this example. You are given a grant of 100,000. Wow, what is happening? A grant of 100,000 for an expense. Revenue grant is an expense. And the expense that you are going to incur, you were going to incur, the entity were going to incur an expense of 120,000, and the government has given them a grant of 100,000. Okay, how will you treat it? This concept says that let me treat the difference between the two and just directly say I incur the expense at 20,000. Why? Because I was going to spend 120,000. The government spent 100,000 on my behalf, and so far as I know, I just spent 20,000. Please, does it make sense to you? Is that okay?
Sir.
Is that okay?
Yes, sir. Yes, sir.
All right. So you just treat the expense of 20,000. Then this one is saying that no, if you do it like this, you are not showing faithful representation. You are not giving us the clear picture of what is happening. And so therefore, this is what these people are saying. If the grant is given, and sometimes if the expenses are going to happen for a series of time, I'll give you an example of that too. But let's say this one is just in 1 year. All right, this one is just in 1 year. You are spending the amount in 1 year, 120,000. The government gave you 100,000. So these people are saying that, oh, okay, then I actually spent 20,000, not 120, because the government is the one that spent the 100, and the government is not in my books. Now, this concept is saying that, oh, no, don't do it like that. If you do it like that, you are not showing faithful representation. And therefore, tell us that you received the grant, but you also incurred an expense. We all know that in the P&L, expenses are put in bracket like this. So these people will say, oh, then let's treat the grant as other income. Other income, government grants. So that everybody will know in our book that government gave us grant. So other income will be 100,000. Then in our expenses, let's also show that we actually spent 120,000. At the end of the day, you realize that it's still the same thing, technically, true or false?
True.
Yeah. So that is that. That is the two schools of thoughts over here. If you, let's say, receive a grant for 100,000 for, let's say, 5 years, and the expense is 120,000, you are going to also spend it over a period of 5 years. It means that in every year, you have to divide this one by 5 and divide this one by 5. The same methodology apply. So what will happen is that you have to split this one over 5 and split this one over 5. So where each of that 5 goes as expense, so you can decide to, this school of thought will say, okay, the difference is 20,000. I will divide it over 5, which is 4,000. So every year I'll record an expense of 4,000. These people will say, oh, no, don't do it like that. If you do it like that, it doesn't show the clear picture. And therefore, every year, if I spend this one, the other income over 5 will be what? 2,000, 20,000, right? When you split this, it's 20,000, right?
Yeah.
Over 5. And when you split this one, it will be how much? Over 5.
24,000.
24,000. Is it not the same thing you are seeing here? The net effect, is it not the same?
Yeah.
So that's the revenue grant. But you see, it's cheaper or easier because there is no depreciation in this one. The same example, you are going to spend asset amount of 120,000. Government gave you a grant of 100,000, but this one is an asset. So the direct people will say that, okay, I actually spent 20,000, the same thing for the asset. So they will record 20,000 instead of expense. This one is an asset. So they will record the asset at what? 20,000 in their books. Now, what will happen is that this asset, so let's say the grant is 5 years, both of them are for 5 years. So the grant, the useful life of the asset is 5 years. The grant is also given for 5 years. So this one, what will happen is that depreciation therefore will be the same thing here, 4,000, right? That will be the depreciation in the P&L. And when we go to our SOFP, what will happen is that our carrying amount will be the 20,000 minus the 4,000. So 20 minus the 4,000. So our carrying amount will be what? 16,000. So that is what this school of thought is saying. All right, that is it. Now, when it comes here, the deferred, it says, oh, no. Let's use this approach. So we will buy the asset at 120,000. Which means that the depreciation will be how much each year? You said it's 24,000, right? That is what will happen. But the grant that the government has given us, let's defer it. Where do you defer? And amortize it. So if you amortize the grant will be 20,000. So you also record other income in the P&L for how much? 20,000, right? At the end of the day, you are still getting this. But in the SOFP, the changes happen so that the NCA, the CA of the NCA carrying amount will be what? Will be 120, right? Minus 24,000. So please give us the figure, the cost minus the depreciation. Then in the NCL, you would defer the balances of the grants. All right. So what will happen is that, well, some people go ahead to separate it, but it is good practice, because the one that you release, so this one is saying that you amortize the grant over the 5 years, which every year is 20,000. You've already released in the current year the one that is going to the P&L, 20,000. So the one that will be coming in the next P&L, which is the 12 months, which we call current liabilities, you are going to put the remaining 20,000. The next 20,000, which will be flown there. Then how much will be left? I think 60,000, which one will be non-current? Please, it's not a liability, it's a deferred grant, and therefore this is how you treat it. It's not a liability that you owe, it is money that you have received in advance. So you see that in every year, what you will do is that you credit your NCL or your CL, then go and debit, you will release it, let me use that word. You will release it over here. You release it. Let me even remove the bracket for you to get it proper. Just put it in there. But the understanding is that it is not a liability. It is an income that you have deferred over there. Please, let's note that, because the credit is here, the debit is here. All right. So in the next year, when you now, what do we call it? This one is here. When you now cancel off, you bring the credit here. That is what you are doing. So the debit is here, the credits are here. Let me just say it like that. But what I'm trying to tell you is that I'm putting it into brackets so that you don't look at it as if it's a liability. It is the government that gave you a grant, so it is not a liability. You've just deferred the grant. All right. So every year, so let's say if this year is 2017, which you have done this treatment, when you come to 2018, this one will be gone. But we know that depreciation every year will be 24,000 because of the useful life. So you do 24,000 again. Then you release this one now into other income of 20,000. Then you will shift to 20,000 back to this place because that is the grant that you receiving the following year. So therefore the balance here will be what? 40,000. So by the time the 5 years is over, everything will be nil, nil, nil. Have I made sense, please? Please, have I made sense? Any question?
So please, in your books, are you also going to put it into brackets under the NCL and the CL?
Please come again.
I'm asking that in your books,
Mm-hmm.
once you have amortized the grant,
Mm-hmm.
and you are putting the remaining at NCL, then the following year's one at CL,
Mm-hmm.
are you to put it into brackets in your books?
Yeah. They are all in bracket. See, I put the bracket there to show you that, if I see NCL is non-current liability.
Yes.
But this one is a grant that you have received. And I will defer grant. We defer, so you are releasing it every year. So I just put it into bracket to I can just leave it open like 40,000, but I'm just trying to let you understand that it is not a liability that you have to pay. Liability is an obligation that you have to pay somebody. But this is a grant that you have received and deferred. Please, are you getting it?
Yeah.
Yes. So I'm not saying that you are not going to pay the grant, are you? It's money that you have received, unless you are going to be reversing the grant.
Okay.
Yes, that is why I put it in bracket. So that if I leave it open, somebody say it will be a liability, but it is not a liability. It is money that you have received. So it's an opposite of a liability. That is why I have put it in bracket here. So that if I leave it open, somebody's interpretation will be that, oh, it is a liability, but this is grant that you have received. And therefore it takes the opposite end. That is why I put it in a bracket.
So in totaling your SOFP, totaling your equity and liability,
It won't balance. So this is not it won't balance like probably you want to see it. What is the figure that you get here?
This is 196.
It's what? 96.
Yeah.
So you are thinking that when you add when it used to be 60 and 40, it will balance it. It won't balance it.
Okay.
Sometimes it depends on the question. Some questions maybe are all arranged a balance, but the purpose here is not the balancing.
Okay.
It's the treatment.
Treatment.
Yes. Because when you are doing P&L SOFP extracts, you don't expect balancing.
Okay.
Please, is that okay?
Please, if you can quickly go over the asset grants for us.
Yes, I'll do one more time. Somebody has asked. So, and I need you to listen carefully, like I always say, because that is what we are going to be practicing anyway. Because no question will give you a revenue method. And nobody, even if the grants come in your exam, nobody will tell you to do the direct one. It is the deferred one that will happen. Okay, so all that I'm saying is that the deferred one, so this is the example. You are going to buy an asset. The cost of the asset you are going to buy, let me change the figures now, 200,000. That is what you are going to buy the asset for. But the government is giving you a grant of, let's say, how much should I use? Let's say 150,000. I don't think you had a problem with the direct one, right? The one that will say, okay, let me just do 50 and divide the 50. So useful life of grant and asset is 5 years. The one that says that, oh, let me just use the difference 50 and divide it by 5. That one you don't have a problem, or that one too I should go over. Class, I'm asking a question.
Go on.
Please go over.
So the direct one is saying that instead of treating the deferred concept, we are treating the direct method. The direct method is saying that I will treat the difference, which is the 50,000, the difference. Then this one will be my asset because I was going to buy something for 200,000. The government paid 150,000 for me. So the direct people are saying that instead of recognizing all those plenty English, I just spent 50. The rest was done by government. So they don't bring the government into their books. They just say they bought the thing at 50. Please, it's like those of you, your guys, or let's say your boyfriends or your husband support you in buying something. Your friend will ask you, how much did you buy the thing? Instead of telling your friend that, oh, the thing is 200,000, but my boyfriend gave me 150,000. You don't want your friend to know that your boyfriend or your husband gave you 150. So you just directly say that, oh, me, I just spent 50,000 on it. That is all. Just to give a picture to your friend that, oh, I didn't know him say 200,000. Oh, what on a full at 50,000. But you didn't add a part of the story that says that my husband gave me 150,000. As you people don't want to promote us. That is what the direct method is saying.
That is not true.
You did then say it's not true.
So let's go on. Let's go on.
Then
that is their character from the day of Adam. Let's go on.
Then, so instead of that, they will just depreciate this thing over the 5 years. So it means in the P&L, the depreciation will be how much? 10,000 every year. Please, are you getting it? And the SOFP, we all know how you get your carrying amount. It is depreciation less what? Cost less accumulated depreciation, which will be the 50,000 minus the 10,000. So your SOFP balance will be 40,000. Please, this is the direct method. That's all. It's very, very simple. If you don't understand, then it means that you have decided not to understand. Please,
So
the person talking. Yes.
Okay, so that means that with the direct, we will not recognize the 150,000 anywhere.
Anywhere, just like we did in the revenue grant. You don't bring it to the story because they are saying that it is the government that spent that money. It is not me. It is not the company. Please, are you getting it?
Yes, sir.
Yes. But you see, accounting doesn't promote those kind of transactions, these ones, because if you've learned your conceptual framework very well, it talks about offsetting. IAS 1 talks about the fact that offsetting is not allowed in the conceptual framework or in treating accounting transactions. So if offsetting were to be allowed, then we wouldn't do sales less cost of sales. We would just record net sales, then start our P&L. But that is exactly what these people are doing. But accounting, IAS 1 frowns on offsetting. But you see, sometimes what a standard says is what you follow. So even in the conceptual framework, there's a statement in there that says that when there's a clash between the conceptual framework and the standard takes precedence. So that is exactly what is happening. But this standard also gives another option, which we call the deferred. So the deferred one will bring the government into the picture, but it will amortize the grants. So what it is saying is that, okay, I bought the thing at 200. So the cost is actually 200, not 150. It's actually 200. Now, if the cost is 200, we know that we would be depreciating the cost over the useful life of the asset. So you depreciate it over 5. And how much is that? 40,000, right? So every year's depreciation will be 40,000. At the same time, the grant was also given in respect of the asset, and therefore the grant too has to be also amortized. And therefore, amortization of the grant is also 150 over 5 years, which is 30,000. So every year, you treat the grant of that 30,000. Now, the deferred one is saying that we would defer the grants and be releasing the 30,000 into our income statement year on year. But when you are deferring the grant, where are you deferring it to? Where do you put it? Where do you put it? And that is what the accounting transaction that I did for you. So where do you put it is the answering of the P&L and the SOFP. So we know that in the P&L, what is going to happen is that we are going to expense depreciation. And please, depreciation is an expense. It's always in bracket. So we say depreciation for the year, expense is how much? 40,000. Expense. But there is also an income. What is the income? The grant that we receive from the government, which is also for 5 years. So we are amortizing it 5 years. So government grant of 30,000 is an income. So it's like this. But you see, at the end of the day, if you check this thing well, it's equal to this one. Ally?
Yeah, the same thing.
It's the same thing. It's just that this one is saying faithful representation. Show us everything. Everything. Don't do offsetting and just show one lines. Show us everything. In the SOFP, what is going to happen is that our CA is rather the cost of 200,000 and the depreciation for the year which we've taken out, which is 140,000. 40,000, giving us 160,000. So that is what you've done. However, in here, you bring some NCL and CL. What are you going to be putting there? It is the balance of the grant. You see, the thing is 150. And so therefore, there is deferred grant. Deferred grant. You see, we can just bulk the thing all under NCL and put 120. But in accounting, we all know that the one that is immediately like 12 months ahead of you is called current, and the one that is after that 12 months is called non-current. So the next 30,000 will be released over here. And the reason, see, the reason why I'm putting this thing in brackets is to clear your mind that it is not a liability. It is an income, a grant. That is why I put it in bracket here. If I leave it like that, it gives a picture that is a current liability. What is a liability? It is money that you have to pay. Okay, that is why the reason why I put it in bracket here is to tell you that it is a grant income, not a liability. Please, these ones, they are basic accounting things that you learn when you started learning accounting. As in, liability is a credit balance. When we put it in bracket, we are giving it as if it is the position of a debit balance. But it is a presentation, okay? So take note of that. Then the remaining 120 will be here. So if you add this one to this one, and the one that you have treated over here, how much are you getting? Is it not the 150? Or it's more than that too. Or say this one should be how much? It should be 90 rather, right? This one should be 90. So if you add this one to this one to this one,
120 plus
get
30
to
to 150.
150. Please, is it okay?
Yes, sir.
And if you don't understand, let me know which part of this you don't understand.
Please, why 90,000? Sir, please, why 90,000?
The grant is
Hello,
150,000.
sir.
It's 150,000. The grant is 150,000. You've treated 30,000 over here. The next 30,000 is here, making 60. When the balance left is 90, so that at the end of the day, you have 150. Is that okay? I think you have a problem with network, so you may have to respond typing. All right. So that is all about government grant. The only thing that I may have to add is what we call reversal of the grant. Reversal of the grant. Now, the reversal of the grant happens so that the company thinking that they've received the grant already and done this all treatment that we've done, it happened that they are not able to fulfill some of the conditions of the grant, and therefore they have to reverse the grant. If you have to reverse the grant, then it means that you have to do the opposite of everything that you have done here. That is the only thing that you have to do.
Sir, please, so the reversal of the grant, is it the same as the repayment of the grant?
Yes, please.
Okay, thank you.
So you see, if you are going to reverse this grant, reversal or repayment, as you would want to put it. Hey. So if it was this method that you applied and you are going to repay or reverse the grant, you see that with this thing that you did, you only treated 50,000 in your, what do you call it? Your assets. And therefore, this is how your depreciation was done. So it means that you have to come back and increase your assets again with the remaining 150 and depreciate the remaining 150 because now the grant is off. So you have to increase your grant to make it, increase the assets to make it 200,000. So you have to record back the 150. Then what will happen is that the depreciation too will have to increase because the 150 that comes will also be depreciated. So the remaining 30 will come, making the total to be 40, like this one. So the grant did not exist anymore. So what you do is that you reverse this treatment by recording an additional, increasing your assets by 150,000 and amortizing or depreciating that one. So that is that. Now, when you come to the deferred, you already treated your asset as 200,000. So you can't increase the asset again, but you have to create a liability. Now, you see, you have to create a liability that you have to pay the government. I put this thing in brackets because it is debit, no more credit. If you are going to repay the grant, then it means you have to create a liability of what? 90,000. So that this one will go off. Create a non-current liability of. So you first do those ones that have not been amortized yet. Those ones that have not been amortized yet. So you see over here, you can't touch your SOFP back because it's the correct thing you have done. The thing was 200,000. So when you have to repay the grant, it means that you owe the government now. So you record the 90 as a liability, you record the 30 as a liability. So you see it will be canceling this thing off. Then it's left with 30. The 30 is no more money that is given to you. So what are you going to do? You are going to record an extra expense of what? 30,000, so that it cancels this one off. Please, are you getting it? It will cancel this one off. So that is what you have. So that everything will be perfect. Your expense, your P&L will be 40, your asset will be 40. So you are just doing the reverse of it. But try as much as possible to give proper English to the explanation. How that you pay the grant, it is a liability of payment. Okay, so you create the liability and it will offset the debit that you have here. You offset it. Then this one is a credit here. You will debit it, okay, so that it cancels off. So it's just the reversal. All right. So let's say the expense one to the same thing. The expense, if you are expensing the expense one, we said that the direct and the indirect. The direct was that if in this case, let's say this was an expense, the direct people would do expenses of just 50,000. Now, if the whole thing were to be reversed, then it means that the expense is actually what? 200,000. And therefore, what you would do is to increase the expense, bring in additional expense of what? 150. If you use the indirect or the deferred method for the expense, which said that, oh, okay, so in this case, assuming this were expense, not asset, that one said that you do what? Expense 200,000. Then you do other income of 50,000, 150,000. If the grant is no more existing, then what you are going to do is that you are going to reverse this 50,000, 150,000. All right. So that is all that you are going to. You reverse it by debiting this account, so that 150. And if you paid if you have to create a liability of paying the government, so you debit this account to cancel this one off, and you create a liability of paying the 150 back to the government. Then when you pay, what you will do is that you have to credit your cash book and go and debit the liability of 150 that you have created. Okay, so that's that. So please, any question? Any question? So anyway, so that is grants. Please, any question?
Hello, sir.
Yes, please.
Please, I have a question, but it's a past question. But when I look at the solution, it's somehow cumbersome or it's very ambiguous for me to understand. Can you please summarize it for me? And the question is, detail the requirements of IAS 20 with respect to government grants to aid capital expenditure. If you can summarize it.
What we have done. And it's a question I will give it to you. That is what we have done. Exactly what you have done. So read the question again. Read the question again.
Okay. Detail the requirements of IAS 20 with respect to government grants to aid capital expenditure.
So capital expenditure, that is what you say. Yeah. So we first practice this one. Take this side off. The requirement is that you can treat it as a direct. You can treat it as a deferred. If you want to treat it as a direct, you explain this one. If you want to treat it as deferred, you explain this one that we have done.
Okay. Okay.
They didn't give you more amounts, right?
No, please. There wasn't any amount.
And that is the corporate reporting for you. I told you that in corporate reporting, you are not going to be asked sometimes to use the figures, but express your understanding of how it is treated.
Okay.
So you just say that the company can choose to offset the grant against the expenditure that they are going to incur. And this is the explanation to it. They can also decide to amortize the grant and defer it in the non-current liability and treat the full amount of the capital expenditure as the asset, like we've done here, 200.
Okay.
And so you see, it is this thing we have done, which you are going to put it into English. That's all. That's all. That is why I always tell you that understanding the thing we are doing is the most important thing you need. It's the most important thing you need. If you understood what we've done, translating this thing to an English, you should finish it in 6 minutes.
Okay.
Yes, exactly. I will give you the same question anyway. It's actually it's an SCCA question, and it's also a Nigerian past question, and Ghana also adapted that part.
2019.
Yeah, unfortunately, I think so you people will have to forgive me too.